Hello everyone, welcome back to the channel. We're being festive today. I've got the green light for St. Patrick's Day behind me. I have my green Art Deco hoop earrings on, and that's as festive as your girl's gonna get because I am Italian and German, so take it or leave it. Besides, I don't have a boss except this beautiful creature, Bobo, who has the most beautiful green eyes, and she looks so cute with the crocheted beret hat my daughter made for her. She looks so commanding and regal with that hat on. I think it is adorable and precious. So for today's video, I have a lot of stuff that I've been wanting to cover. These are sorts of like signs of the times type of things that maybe on their own didn't justify an individual video, but it's something that I've been wanting to cover. So we'll just go ahead and get into it. I am going to try to keep this brief. You know how difficult that is for me. So the first thing I want to cover is the fact that the European Central Bank is going to be launching the digital euro CBDC in October of this year, or at least that's the date that they're forecasting it for, despite concerns regarding central bank digital currencies being a Trojan horse to limit the public's privacy and freedoms. ECB President Christine Lagarde said that it is critical and more relevant than ever to push forward. Of course.
European Parliament, meaning European Council, meaning European Commission, so that we can eventually, not put to bed, but put to reality this digital euro. The deadline for us is going to be October of 25. And we are getting ready for that deadline, but we will not be able to move unless the other parties, the stakeholders, as I call them.
The stakeholders, right. This is so disgusting. Human Rights Foundation says CBDCs, the end of financial freedom. Of course, authoritarian regimes like China and Nigeria use CBDCs to track transactions, freeze funds, and silence dissent, erasing financial privacy and civil liberties in the process. Yes, that is the main goal. Christine Lagarde confirms that it launches in October, the European Central Bank CBDC. They will tell you that it is about convenience, but they will track every payment, block purchases, and control where you can spend. CBDCs are not money, they are permission slips. This is absolutely correct. They will track every payment. They can block purchases. For example, you can't buy meat this week. Your carbon footprint is too high. And yes, they would have the ability to do that. They can, at the granular transactional level, they could stop you from purchasing something they don't want you to be able to purchase. That is why CBDCs are a terrible idea. They can be used to control movement. Your money only works where they want you to be. For example, if the government says you're restricted to your house basically, or your neighborhood, you're not allowed to travel, they can make it so that your money will only work at places near your home. So that's crazy. They can impose their ideology on you. For example, your money won't work to go on a vacation unless you buy carbon credits. That's the real goal here and the real reason why they're rolling that out. The Kobayashi letter asks, does the US government want a recession? And they point out that this year, 9.2 trillion of US debt will either mature or it will need to be refinanced. The quickest way to lower rates ahead of this colossal refinancing would be a recession. Could the US benefit from a market crash? Yes, of course, because we have these very overinflated bubbles like the housing market, where the prices are so high that young people have been completely priced out. So yes, there needs to be a market correction to bring those prices back to reality. The same could be said of the tech sector. Over the last 2 months, the 10-year note yield has fallen 60 basis points. This is partially due to anticipation of Doge deficit spending cuts, but it is also due to increased uncertainty and rising odds of a US recession. Guys, we have been in a recession since 2022. I don't understand like who these people think that they're fooling. A recession would almost guarantee rate cuts. And I don't think that's a good idea either. Why would a recession guarantee lower rates? Every US recession dating back to the 80s has followed a peak in the Fed funds rate. When economic growth stalls, the Fed prints more money to quote unquote stimulate the economy. This means lowering interest rates to lower cost of capital to promote spending. The problem has been the cheap money. The problem has been the low interest rates, near zero in some cases, that make investors less risk averse and less responsible because it's cheap money. So when you have higher rates, people are less inclined to make risky to take risks, right? They're more responsible with their investing. Since the trade war began, and make no mistake, we are in both a trade war and in a global economic war. And we are also at war in the Middle East right now. That's another thing. Since the trade war began, economic growth forecasts in the US have cratered. Oil prices have also cratered to a fresh 6-month low. Here's where it gets even more interesting. President Trump has said multiple times he wants to lower oil prices to lower inflation. On January 25th, Trump claimed to have a solution to the Fed's 3-year-plus battle against inflation. He demanded OPEC lower oil prices and that the world drop interest rates. However, the quickest way to lower oil prices would be a recession, which reduces demand. Yeah, if you're in a recession, you don't have the money to go out and go to places as much as you used to. You're needing to save money. And so, yes, take a look at Trump's most recent interview with Fox News. He comments on his priority of getting interest rates down. He says, interest rates are going down. I'd love to see energy go down too. U.S. consumers believe inflation will rise to over 6% over the next 12 months, the highest since May 2023. Gee, I wonder why. And they continuously lie to us. This marks the third consecutive monthly increase in expectations. Inflation is rising, so is the cost of living, and yet wages remain stagnant. The jobs market is dead. It's a very bad situation. Markets are pricing in a recession. In a trade war with surging inflation, drastically lower rates are almost impossible without going into a recession. Like I said, we've been in one since 2022. And to top it off, President Trump said on March 6th that he's not even watching the stock market. As we saw in his first term, he's always watching the market. Trump's statement on not watching the market was telling. He clearly is watching the market, so it's his way of sending Wall Street a message. He is willing to do whatever it takes to lower rates and reduce the trade deficit, even if this means going into a recession, which I maintain we are already in one. Amid all the trade war chaos, we have seen economic growth expectations crash sharply. Oh, yeah, the Atlanta Fed has reduced their Q1 2025 GDP growth estimate to now be in the negative, to negative 2.8%, negative growth. It's amazing. Like people, I had somebody say to me online the other day, I was saying that people are not prepared for what is coming, and I had somebody comment like that's to the effect of, when nothing happens, are you going to apologize for your fear mongering? And I'm just sitting here thinking, like, what world are you living in? Are you not seeing it when you go to the grocery store, when you go to pump gas? Like, how do you not? I mean, really, and everybody knows this is not sustainable. I didn't think that that was a controversial thing to say, and just saying people aren't prepared, that is the truth. Most people don't have money saved, they don't have food stocked away, they don't have water. They maybe have at most 6 months cost of living expenses, if that. But most Americans live paycheck to paycheck, and they are simply unprepared. They're overworked, they're working 2 to 3 jobs. I just heard today that even college graduates are working multiple jobs just to try to stay afloat. So these comments, it's just like, what are you expecting to happen? Do you think it's just all going to overnight crash? Like, we are in a slow motion crash that has been going on since 2008, but really, I mean, the problems go back decades. So, comments like that always always make me like laugh. It's silly. As a result, we saw interest rate cut expectations move up sharply last week. Was this intentional? High interest rates are the government's biggest problem. Debt service costs have soared with the surge in interest rates. The average interest rate on 36.2 trillion of debt. Did you know back in like 2008, the debt was at 10 trillion. It is now way surpassed that. This is unsustainable on so many levels. So the average interest rate on the 36.2 trillion of debt is now 3.2%, the highest since 2010. The government needs rate cuts more than anyone. Yeah, and its urgent rates drop soon. The maturity schedule for the 9.2 trillion of US debt is heavily weighted to the front half of 2025. So between January and June, 70% of that debt will need to be refinanced. The average rate on this debt is set to jump by 1 percentage point. Furthermore, Doge efforts to reduce deficit spending won't happen overnight. These things take time to really be felt. They've gone in there and they've cut a lot of stuff, but then they pass these spending bills where they're increasing the deficit more than like Doge can decrease it and reduce it. It's frustrating. In fiscal year 2024, the US saw 7.8 trillion in gross costs and just less than 5 trillion in revenue. So that is 1.56 of cost for every dollar of revenue the US is generating. So we are in the negative. We are spending more than we are making at this point. The debt crisis will take years to fix. Indeed, they will. Okay, so I thought this was interesting too. Just another thing to consider. Credit agencies have misrated more than 100 billion of commercial real estate debt in an increasingly popular segment of the market, including at least a dozen deals that maintain top investment grade ratings even though borrowers are in default. The questionable ratings are cropping up in deals backed by one loan or mortgage on a single major office building rather than on a bundle of multiple properties. Single loan deals now make up 40% of the nearly 700 billion in outstanding commercial mortgage bonds. One of those deals, 1407 Broadway, is a 48-story tower in New York City's Garment District that is now facing foreclosure. The owner, San Francisco-based Shorenstein Properties, has not made a payment since July on the mortgage for the building, which is no longer generating enough rent to cover expenses and interest payments. Nonetheless, 187 million in bonds tied to the building's debt are still put at AA rating by Fitch. For most highly rated mortgage bonds, a single loan default might not impact its rating or an investor's ability to be repaid, but the 350 million bond deal for 1407 Broadway, more than half of which was rated AAA, is backed by the fortunes of 1407 Broadway alone. Scrutiny of these deals increased recently after investors lost 26% of their initial investment in a bond originally rated AAA and backed by a single building, the former Manhattan headquarters of insurance firm Money at 1740 Broadway. The building was recently bought by Blackstone, of course, for $605 million in 2014, but was recently sold in foreclosure for just $186 million. And that's citing this article here from the Financial Times. Ratings agencies give high marks to bonds financing defaulted properties. This is crazy. Absolutely wild.
The underlying loans are clearly deteriorating.
Yeah, this is the problem. Okay, so moving on. What is the Mar-a-Lago Accords? The Mar-a-Lago Accords is an idea that the United States will give the G7 companies, the Middle East and Latin America, security and access to U.S. markets. And in return, those countries agree to intervene to depreciate the dollar and swap existing government debt with new U.S. Treasury century bonds. So they take 100 years. It's just ridiculous. So what do we get out of the Mar-a-Lago Accords? The U.S. is giving the rest of the world security and access to their markets and consumers. What we get from the world would be a weaker dollar. That's not good. A bigger manufacturing sector. That is good. Existing U.S. Treasury debt swapped to these new Treasury century bonds. Two tools to achieve such an outcome: the tariffs to grow the U.S. manufacturing sector and exert pressure on countries to sign the Mar-a-Lago Accords, and a U.S. sovereign wealth fund that can be used to sell foreign currencies to depreciate the dollar. I think that part is not good. Chaos hits European debt markets. Yesterday, European bond markets experienced turbulence as German government bonds closed the day on their worst performance since the collapse of the Soviet Union. Statements from European leaders expressing their willingness to continue the conflict until the last Ukrainian soldier, without the support of America, failed to inspire confidence among investors. Gee, who could have guessed? The reality is such a compromise comes with a huge cost, one that Europe simply cannot afford. I agree. Moving on, Dale Stark says, I'll never get the government obsession with stopping price corrections at all costs. Take real estate. Prices are crazy, locking out tons of hardworking young people. Let the prices drop. Lower prices means first-time buyers can finally purchase a home without selling their soul. And Idaho Joe says, let the market corrections happen. I agree. The government has no obligation but to protect the rights of the people. Covering gambling debts of the wealthy is not their job. That's true, but let's be honest. The government is the wealthy. The worst German bond performance in the last 35 years, major unfolding crisis in European debt markets may significantly increase borrowing costs for the EU, and it could lead to sell-off in EU debt and be contagious for other global markets. So that's nice. And then we have a thread here. Trump cutting off the tap to Ukraine. As he announced, China just dumped 25% of their U.S. Treasury holdings. Wall Street is quietly repositioning, but people have no idea what is coming. Here's how to prepare for when the party dies. Guys, the party is over. It's been over for a long time. For decades, America operated on the simple premise: print dollars, export inflation, import real goods. Other nations accumulated our debt as reserves. This system worked flawlessly until 2008. Then we witnessed the first cracks in the foundation. The 2008 response seemed to work. No, it didn't. It never worked. Massive QE, zero interest rates, and market intervention, but it merely masked deeper structural problems. Each crisis required exponentially more intervention. The C-19 response would expose the system's fatal flaw. Yeah, I think that what people need to understand is that was a massive transfer of wealth. It was a wealth transfer. $5 trillion in new stimulus broke something fundamental: the bond market's capacity to absorb new debt. Foreign buyers began questioning the entire model. The numbers reveal a startling transformation. Yeah.
In early March, overall share prices in companies listed here were falling, and the S&P only rallied the day after the Federal Reserve, America's central bank, announced it would be stepping in with a series of enormous aid packages to help prevent economic disaster.
Yeah, but it didn't prevent economic disaster. It just kicked the can down the road and then made things much worse. The Treasury market tells the real story. Primary dealers are struggling to maintain liquidity. Bid-to-cover ratios are declining, and the Fed is becoming the buyer of last resort. Here is where it gets truly concerning. China's exodus isn't random. Their combined holdings dropped 25% from the peak. They're being replaced by buyers from tax havens. The same pattern emerged before previous monetary resets. Historical parallels suggest what happens next. The 1920s saw similar market distortions. Credit expansion masked structural weakness. Foreign creditors began withdrawing quietly. Mysterious entities then stepped in to maintain appearances. The resemblance to today is uncanny. Look at the military spending trajectory. 80 bases, or bases in 80 countries, becoming unsustainable. Why do we even have bases in 80 countries? That's ridiculous. We don't need to be the world police. Non-combat personnel facing unprecedented cuts. The empire's financial foundation is crumbling. This explains recent political developments. Trump and J.D. Vance's Ukraine stance is not ideology, it is pure financial necessity. The numbers show we are approaching a mathematical limit. Foreign commitments are becoming impossible to maintain, and the implications extend far beyond politics. The global financial architecture is transforming. BRICS nations are creating parallel systems. Oil trades are shifting away from dollars. Central banks are stockpiling gold at record rates. These signals point to a systemic shift. Indeed, the bond market is flashing warning signs. Yield curves are severely distorted. Liquidity is evaporating in key sectors. Traditional correlations are breaking down. The data suggests an imminent phase transition. Market stress indicators are spiking. Cross-currency basis swaps showing strain. Repo markets requiring constant intervention. The plumbing of the entire financial system is clogging. Yet most investors remain unaware. The transformation will reshape everything: global trade flows, military alliances, financial markets, reserve currencies. The next 24 months will become crucial. I agree. And I think that, yes, pattern recognition is important for this. But yeah, this is where we're at. And Japan, this is a global thing, by the way. It's not just the United States, it's global. Japan 40-year bond yield hits highest in history. Eventually, markets will remember that Japan has to roll over the world's biggest debt load ever assembled. Lord have mercy. Japan has 4% CPI. They have to raise interest rates. But with government debt, refinancing costs will soon become unmanageable because they can't pay 5%, and yet they have to. This is the end of the Japanese special way and the infamous US dollar Japanese yen carry trade, an abrupt unwind of the dollar yen carry trade where investors borrow cheap yen to invest in higher yielding dollar assets could trigger a global depression. The yen would surge as positions are closed, pressuring the dollar to go lower. US asset prices, especially debt instruments and equities, could drop due to forced selling by funds who rely on short-term financing. Japanese markets might face volatility as repatriated capital floods back. Globally, risk-off sentiment could spike, hitting emerging markets reliant on dollar funding. U.S. tech stocks sensitive to rising risk aversion and higher borrowing costs could see sharp declines as investors dump growth assets for safety. Think NASDAQ dropping 15% in the panic. And I would also suggest that for U.S. tech companies, they also have to contend with China now. Bitcoin, often a leveraged risk-on play, might crater even more, potentially towards 40K as liquidity dries up and speculators unwind positions. It was very close last year. The Japanese bank Norinchukin, I'm probably saying that wrong, is still not stabilized. Expect more ripple effect through the shadow banking system. All in all, the markets are dependent on a constant supply of liquidity, otherwise the bubble will burst and the economy will go into a tailspin. Well, it's already in free fall right now. Then we have the DeepSeek effect and now the even bigger Manus effect. The Chinese are offering exceptional software, namely open source software. Who still needs Microsoft products when the solutions are offered for free on Chinese servers? It's a loss of confidence in US exceptionalism. Last Monday, the NASDAQ 100 experienced a loss of 1.1 trillion. Investors are pulling out of US stocks and turning to Chinese companies for these reasons. Then there are the cyber attacks on X. If we want to entertain the idea that we didn't do that ourselves, attacks on Tesla factories, etc. Is it possible that some force wants to shoot down the US economy to scapegoat this new incoming administration? I would say that's possible, but you can't blame them for something that they inherited when they've only been in for 2 months now, 3 months. That's not enough time for any of these policies that they're changing to take any effect, so I don't think they can really be blamed for it. But that doesn't mean they won't try. Whatever the explanation, any disruption will end the exponential debt growth that is currently driving the stability of the system. Any disruption will lead to a dangerous reversal of the system. Various houses of cards are currently collapsing before our eyes. No one can cope with the complexity anymore. Chaos is inevitable if the spiral is not stopped immediately. This is the reason that the European Central Bank announced that they are launching their CBDC in October of 2025. This will mark the beginning of the end of financial markets because in a centrally planned economy, there is no need for free markets or individual property rights. Indeed. Whitney Webb says Mark Carney, Canada's new yet unelected prime minister, has spent the last several years selling a new version of neo-colonial debt slavery as, quote, sustainable development, a complete snake. Please read my past reports on his predatory endeavors. So make sure to check that out. And Scott Bessent on CNBC, the market and economy have become addicted to excessive government spending, and there is going to be a detox period.
Top 10% of Americans are 40 or 50% of consumption, and that is an unstable equilibrium. The bottom 50% of working Americans have gotten killed. We are trying to address that. We're trying to get rates down, and could we be seeing that this economy that we inherited starting to roll a bit? Sure. And
for who is seeing that besides like the top percent of earners?
And, look, there's going to be a natural adjustment as we move away from public spending to private spending. The market and the economy have just become hooked. We've become addicted to this government spending, and there's going to be a detox period.
Well, that is true. So I will end it on that. I just wanted to make you guys aware of that. I still have a lot more things I want to go through, so I might do a second video depending on how I feel, and I hope you guys have a good day. Whee!